Hello, everyone. I'm Rosalinda Delgado. I'm the Business Development Manager here at Accessity. I have been with the organization for about 11 and a half years. Time flies when you're having fun. And I'm very excited to be here with all of you, sharing my knowledge in small business lending. And of course, our amazing program at Accessity. Accessity is a community development financial institution, also known as CDFI. We have been around for almost 30 years, since 1994. And our mission is to open doors to financial opportunity, primarily to those that historically have had that lack of access to capital, including entrepreneurs of colors, women, immigrants, low to moderate income entrepreneurs, so they can build a prosperous business and livelihood for their families. We service 6 counties in Southern California, including LA, Orange, Imperial, Riverside, San Bernardino, and San Diego. And of course, our main office is in San Diego. And, so far in the 30 years or 29 years that we've been around, we have provided around $75 million in small little loans to small businesses. Now, when we talk about possible funding sources and you're starting your business or growing your business, well, the first thing you're going to think about is, okay, how much money do I have? Can I use my own funds, right? Your savings. Other sources could be grants. Other sources could be family, friends, and fools, right? That wants to give you money. And there are certain platforms online that you can also investigate and tap into to see if they fit what you're trying to do. There, a lot of people have, raised capital through crowdfunding or crowdsourcing. Now, if you are inventing or you came up with an incredible and scalable idea, you might have angel investors interested in what you're doing. We can see a lot of biotech or technology in that area of having investors, right? It requires a certain kind of people, right, to be able to get investors' money. And then there is another platform that provides equity financing. So people buy a little tiny, they put a little money in your business if they believe in it. So it's called WeFunder. I don't really know how it works, but I have heard different stories about it, but you might want to look into that as well. Now, the most popular one, of course, is state financing, because if you're not able to get money from all of these sources that I just mentioned, you're going to go where? To your bank. Or maybe you go to your bank first, and you go to your to City National Bank to see if they can help you. If they cannot, they will refer you to an alternative lender, an alternative responsible lender like a CDFI or a CDC. And today we're going to talk about one of those CDFIs, that is Accessity, that provides loans to those businesses that cannot access capital from the bank, either because they are startups or because they haven't been in business long enough, or they don't have the revenue that the bank is looking for, or they have a risky industry. So when we talk about a startup lending, we can help startup loans, startup businesses, as long as the owner have another source of income. Because a loan is something you're going to have to start paying within a month or 45 days, right? So we want to make sure you have that other source of income that is going to help you start paying that loan until your business start generating revenue. And if you don't have that other source of income because you are vested in your business, you need to bring someone else. It could be your spouse, it could be your parents, or someone that strongly believes in you. You might have a partner that is putting the money, and you might be putting the sweat equity. So there has to be someone else for us to be able to fund a startup business. Now, when it comes to an existing business, we are going to look for revenue. If you don't have enough revenue, right? Because it's less than 2 years, or you're not profitable yet. Again, we're going to see if you have other sources of income. Why? Because we use what is called global income. All of the income that comes into your household, right? Or your accounts. Now, it could also be because you were changing your entity. Let's say you were a DBA and now you are an LLC. So banks require that you are 2 years, that you have in business for 2 years. But if you change your entity, right, they're going to consider you as if you started the day you just started your LLC. We can look back into when you were a DBA. We can look into those transactions and those financials as well. We can also help people that are in the retail industry, food and beverage, transportation, certain risky industries that we are able to fund as well. It's important that everyone is current on all their accounts on their credit, because even though this is a business loan, it's a personally guaranteed loan. The purpose of the loan could be many things, right? Anything that is related to the business. We cannot lend money to buy a personal car or to refinance a personal car. So it's all business related expenses. So if you use your personal credit card to fund your business, then you have a problem, because it's going to be very hard for you to for us to help you. Now, also, one thing we do not fund is product development. Let's suppose you're an inventor and you're inventing this product and you need money to do the prototype. That is something we cannot fund, because we don't know when are you going to be able to start selling that product. So how is your request being evaluated when you are in underwriting? Basically, we use every financial institution will use what is called the 5 C's of credit. And these are the 5 C's of credit. When we talk about character, we talk about your credit history. You are the owner of the business. You are the main person, the key person. So we want to know, what is your financial reputation? We're going to look up your credit to see what your history is. We also want to know what is your experience in this particular industry, or who is going to provide that experience if you're bringing other people into the business. We want to make sure you have capacity to make the payments on the loan. So as I said earlier, we're going to look for the steady source of income or bring a co-borrower. Now, a collateral is basically, if we are financing a piece of equipment like a truck, we are going to take that truck as collateral for the loan. And we are going to install a GPS on that truck. It's important that we know the value of the truck. We're going to appraise the truck to make sure the truck has the value of the money you're asking for. We also might decide to purchase the vehicle or the truck directly from the seller. That's what we call controlled dispersal. When it comes to capital, it's basically how much money, if you're starting a business, how much money do you have available to start that business? It could also mean, tell me how much money you have, right? That you might not want to use in your business, like a 401k or pension, money that you have for your retirement that you might not want to use for your business. That's where you're coming for a loan. That's important because it gives the lender a sense of comfort, because they know that you have money set aside that you don't want to use, and if worse come to worse, or if something happens, you're going to be able to tap into those funds and you won't be left with nothing, right? Conditions basically is, does your business make sense? Are you the product are you selling is right for this economic environment? And what are the use of funds? What are you exactly using the money for? To give you an example, if you come to me and tell me, Rosalinda, I want to start a business selling masks, right? And I say, I think you're too late for masks. Everybody is making masks, or we have masks everywhere. We can get them for free. Why you want to sell masks, right? It's like, it's too late for that, right? Maybe in 2020 when the pandemic started, like I have a client that made $4 million in masks, because she did it at the right time. So in terms of global cash flow, which is basically what we use to calculate your ability, to capacity to make the payments on the loan, is basically, the formula is basically all sources of income, including personal and business, if you have revenue, minus all your personal expenses, your personal debt, your business debt. We're going to come to a number called the discretionary income. Is whatever is left, right, from everything else. That discretionary income has to be enough to make those payments every month. If that discretionary income is not enough, we might drop the amount or we might decline the application. What are the most common mistakes that people make? The most common mistakes that borrowers make is they're not prepared. They go ahead and fill out the application, but they don't have the documents ready. And that is of essence. Time is of essence. You need to submit your documents in the next 5 days or your application will be withdrawn. So it's important that you have everything you need to submit that application before you fill it out. Now, another mistake is, talk to the bank. Borrowing money before speaking to the experts. Instead of going to all these websites, right, that offering you money, make sure you talk to people, experts, SBDC advisors. There's plenty of resources in Southern California that can help you make the right decision. Don't spend the money before you have the funds in your bank. I have had loans decline at the last minute after they have been approved and they have the guarantee being declined. The other day, I had a client who we were going to disburse the loan, and we did a soft pull on his credit, and he had bought a Mercedes-Benz or a BMW for $86,000. So that immediately changes the picture, right? It changes his ability to make payment because now he has an additional payment that we were not counting on, that we didn't know about. So what we did, we approved the loan, but we dropped the amount to the amount that will fit his current discretionary income. Now, don't sign any contracts or leases before you have the money in hand. You have no idea how many people have had to go bankrupt in order to get out of a lease that they cannot pay. Make sure you are not refinancing your house at the same time you're applying for a business loan. Set your priorities. What's more important, my house or my business? Okay, it's my house. I'm going to refinance my house first. And then I'm going to think about, applying for a business loan. Don't start getting credit cards. You apply for new credit, your credit score is going to go down and your ability to access capital is going to diminish. Quitting your job. If you're starting a business, don't quit your job. Don't quit your job. Transition it to your business as you are generating revenue, and apply for the loan before you quit your job. Make sure you don't mix personal and business together. Make sure you talk to your banker and open a business account. Commingling is mixing personal and business. How an underwriter is going to see if your business is making money if you are mixing everything together. Make sure you deposit the money, deposit your revenue. Mattress money, we cannot count it because we cannot see it anywhere. And also avoid making large purchases, like this person that bought the BMW where they are going through the approval of a loan. Make sure you're transparent, changing the purpose of the loan. I had a client that initially told me that he was going to move to a new location. And then when we received the application, we sent it all the way to underwriting. He told the underwriter, I'm going to open a second location. That's a duplication of expenses. That immediately changes the whole picture as well. So he was declined, right? Because my estimate was that he was going to be able to pay the loan because he was moving to another location that it's probably going to save him money. No, that was not the story he told the underwriter. So make sure you have a defined use of funds. Make sure you have a breakdown. What are you going to use the money for? If you say working capital, we're going to ask an additional question. Working capital for what? So let's talk about Accessity's loan program. We have a 25K low documentation loan. This program starts at 7.99 until 14.99 interest rate. Is approved in 1 to 3 weeks. The beauty of this loan is it doesn't have we don't fully underwrite the loan. The decision is based basically on your bank statements. Of course, we need at least your tax returns for the last 2 years for 25, maybe one if you're applying for 15 or 8 or less than 10. And we're going to look at tax returns, and we're going to look at least 3 months of bank statements of all of your accounts. Okay, we are going to exclude medical collections, student debt. We're not going to ask for financials. We're not going to ask for a business plan if you're a startup, and we're not going to ask for collateral. And the beauty of it is we only do soft pulls. We don't do hard pulls on your credit. So if you are declined, or if you're declined or you're not eligible, it's not going to show on your credit at all. Now, if you get approved, of course, after that, we're going to report to your personal credit, because we do report to personal credit because it's a personally guaranteed loan. Our maximum term for this product is 36 months, and the closing fee are about 6%. Now, that 6% is basically 3% is the guarantee fee, and 3% is our processing fee. What is the guarantee fee? So you're going to listen to Mark talk about SBA lending. SBA is a federal agency that guarantees loans that the bank made. Our loans are not guaranteed by the SBA, are guaranteed by the State of California Guarantee Program. It's a similar program, but it's a statewide, and that's where we purchase those guarantees, and those guarantees cost money, and that money is passed to you. Now, if you're a veteran or active military, you will get a 1% discount on your interest rate and 100% of your closing fee. Now, all the closing fees are rolled into the loan. And when you get an offer from the underwriter, they're going to disclose your APR at that time. But of course, you can always calculate it yourself with a loan calculator. The documents that you're going to have to submit is of course, you have to fill out the application. You have to provide a state issue ID. Well, right? We need to know who you are. We need to know if you have an entity. So we're going to go into the Secretary of State and make sure your entity is registered, or to the county if you have a fictitious name file, or a seller's permit. So you have to have an entity to apply for a business loan, because the business have to exist. We're going to make sure you provide proof of income. We need 3 months of bank statements, all of your accounts, because we combine them all. If you are applying for more than $25,000, we're going to need year-to-date financials, balance sheet and profit and loss. We're going to need 2 years of tax returns. We're going to need 2 years of tax return for any size loan. And if you're a startup, we're going to need business plan and projections for any loans over 25. Of course, the breakdown of the use of funds for you to be very prepared. And if we're purchasing equipment and taking the vehicle as collateral, we are going to require a copy of the title and a copy of the registration. Make sure the registration is not expired. It has at least 60 days on it. And if we approve that loan, we're going to take possession of that title, and Accessity will become a lien holder. If you are opening a brick and mortar location, we're going to need a copy of the lease agreement or a letter of intent from the landlord indicating they're willing to basically rent the place to you, and what the rent is going to be, what is the size of the space, all the things that we want to know, and the location of the business. This is our website, accessity.org, free to visit, and there's a lot of resources there. And this is our team in Southern California. Wherever you are in Southern California, you have a representative. Okay, Francisco is LA County, Juliet and Joyce are San Diego. Larissa is in the Imperial Valley. She's currently on maternity leave, so I am basically managing her pipeline and answering her calls, and will probably refer you to one of the other videos. Christine is the San Bernardino County, and Melba is Riverside County. I am basically in charge of the Orange County and North San Diego Coastal, North County Coastal. Thank you so much for having me here today. I hope I hear from you, and you call us if you have any questions. And of course, we're going to have a few minutes at the end to answer any questions you might have. Thank you.
Yeah, thank you, Rosalinda. We have a couple of questions right now that I thought you could answer. And then, of course, if there's more questions, you can type them in the Q&A box. You can type them in the chat, and we can ask them now or at the end. But I have a couple of questions now that I wanted to ask. So when someone reaches out to a business development officer, maybe they fill out a form on our website, when they first get connected in like an initial call or meeting, what can the business owner expect when they're talking to the Accessity business development officer for the first time?
So we're going to have a conversation. When you talk to the business development officer, you're going to tell them your story, right? What is it that you're trying to do? We're going to ask questions like, how many owners? Have your entity been registered? Do you have a business account? What is your average balance? So we're going to ask all these questions, but informally, right? Because we're not seeing your documentation. We're going to see how is your credit. You tell us, what your challenges are, if you have any challenges. So at that point, so if you, for example, tell me, oh, I'm a startup and I don't have any source of income, I'm going to tell you don't apply, because, you need to have another source of income. And when we talk to the video is your advocate. If you're not ready, we're going to tell you. And if you're ready, we're going to send you an invitation to apply so you can move forward. But we're going to answer any questions you might have, and we're going to ask you questions. For example, if you want to buy a truck, or if you want to buy a piece of equipment, or if so the purpose of the loan is going to be very important. If you tell me you don't have any income, do you have anyone that can co-sign on the loan, that can come with you on the loan? A co-borrower. How much capital do you have? So we're going to ask you all these questions that the underwriter wants to know, but we're going to ask them to you informally. So if you tell me, Rosalinda, I don't have my accounts, I don't have money in my account, I ran out of money, we're going to tell you, well, don't apply, because you're not going to be approved if you have no money in your bank. So in the next 3 months, make sure you build up your revenue, or we will send you to a business counselor at the SBDC to help you increase your revenue. Because at the end of the day, in order for you to increase your revenue, in order for you to become profitable, you either have to find ways to increase your revenue or reduce your expenses. And a loan might not be what you need at that time. And of course, you won't be able to get approved. So when you're in trouble, is the worst time to apply for a loan. But in this conversation, that's what we're going to do. We're going to assess your situation, give you advice and resources if you're not eligible, or invite you to apply if you're eligible, and send you a link for you to upload your documents as soon as possible so we can get you into underwriting fast.
Yeah, and I think that's a great point. Connecting with that business development officer first, because they are your advocate and they do want to learn your story, especially when going through the lending process. Just a couple more questions. I think it might have been in your presentation, but I don't know if the whole thing was a list of documents required to start a business in San Diego. I believe you can find that on the City of San Diego website. Maybe I can provide that after. Do you know, Rosalinda?
Yes, there is also yes, and even the Small Business Development Center can help you with that. There are resources in the SBA website, in the IRS website also. So the resources are online. Now, the city of San Diego, I will say that they also have, but to start a business, what you need is to register your business, and you're already in business. Now, of course, that doesn't mean you're going to get funding. But if you're going to open a location, you might need, for example, an inspection from the fire department, a lot of things. There is a website called calgold.ca.gov, calgold.ca.gov, where you can find pretty much all the requirements from the government if you are actually open any kind of business. So you can put, okay, I'm opening a restaurant, or I'm opening a clinic, and over there it tells you in that website from the state everything that you're going to need, all the inspection that you're going to need to be able to open your business.
Yeah, I think that's a great website. I'll share that in the chat as well. The city of San Diego also has a document in English and in Spanish. If I can find it here, I'll send it in the chat. If not, I'll attach it to the email after the webinar, called 10 Steps of Starting a Business in the City of San Diego, which is really relevant for anyone in the state of California. It just has the City of San Diego specific links, but it's a really great document that the city put together to make it really, really easy for someone to learn where to start, how to start a business and what you need. So I will definitely either drop that in the chat here or send it out after the webinar. So thank you, Rosalinda, so much. The next question we have actually relates to SBA loans. So we will ask Mark after he presents his presentation, because there were lots of people who registered for this webinar that are very interested in learning more about bank financing, the SBA, what is, an SBA loan, how do I get one? So I'm going to throw it to Mark. Welcome, Mark. I don't think we can hear you. You might be on mute. Oh, there you are.
Sorry, everything moved around on me as soon as I started sharing my screen.
Yeah, no worries.
So hold on a second. Let me make sure that I'm sharing properly. All right, are you seeing my screen?
No, we're not seeing it. We saw it before.
Okay, hold on. Sorry about that, everyone. All right. Now you should see it.
Yes, we see it. Thank you.
Okay, great. So hi, everyone. I'm Mark Morales. I'm Vice President of Community Reinvestment for City National Bank, and I handle SBA marketing and training. I've handled SBA loans for over 20 years. I've been with City National for just under 7 years, and I'm happy to share with you today some of the programs that the SBA offers, and two of the most popular ones. When it comes, and many of the things that Rosalinda had said are very true for the bank as well. But what I want to, really emphasize is, having that conversation with your banker, when you're ready to ask for funds, so that they can move you to the right direction. City National is a commercial bank, so we do lines of credit, we do loans, we do mortgages, we do leases. So we do all types of conventional financing, but I'm going to concentrate on the SBA programs, which is financing through the government guaranteed lending programs. All right. So what is an SBA loan? So an SBA loan is basically a loan that a commercial bank would not do without the guarantee. It allows us more flexibility in, cash flow coverage, debt service, newer businesses that are relying on projected income. But basically, they're loans that the bank would have declined without the SBA guarantee. So there are 3 questions that the bank needs to know and that you need to be ready to answer when you walk into the bank and ask for a loan. How much money do you need? What are you going to use the money for? And how can you demonstrate that you can pay it back to the bank? We're going to take these one at a time. How much money do you need? The answer should never be, how much can I get? This is not a mortgage. We're not looking to see how much house you can afford. What we want to know is, how how much money do you need to operate your business, to grow your business, how that money is going to impact your business and your profitability. We really like to see, it broken up in two ways. How much that you can repay in 1 year and how much is going to take you longer than 1 year to repay. And the reason why we do that is to make sure we match the product, the loan product or the line of credit product to the actual purpose of the funds. A perfect example is, hey, I need a $500,000 line of credit. What are you going to use it for? Well, I'm going to renovate my building. Well, that's something that you would pay over a longer period of time and you more match to a term loan. But if, hey, I need $100,000 to carry my receivables, well, then that's more of a line of credit type of product. What are you going to use the money for? So I don't want to hear I need a $500,000 of working capital. I need to know exactly where that money is going to go and how it's going to impact your business. And these are some, examples of, the types of, areas where you might need financing in, and then what are valid business purposes, for us to finance. You see inventory, production, salaries, marketing, real estate, tenant improvements, contract financing, expansion, or to purchase another business. And this is the one that's most important to the bank. So how can you demonstrate that you can pay us back, right? So what we're going to be looking for is that money coming from historical revenue, profitability from your business, from projected revenue, from contracts or purchase orders, or combination. We need to know, and similar to what Rosalinda said, is where's that money going to come from to pay us back, right? Because we're not charitable organizations. We are for-profit banks, and we need to make sure that you can pay us back because this is how we make money. So we're going to talk about two different programs. These are the two most popular programs for the SBA, the 7A and the 504. 7A loan program is the flagship for the SBA, and it's a kind of a catch-all. You can finance pretty much any valid business purpose with a 7A loan. So you can purchase a building, you can renovate a building, equipment, machinery, inventory, long-term working capital. You can pay your accounts payables, short-term working capital needs. You can finance your receivables. You can refinance the existing business indebtedness. And what I mean by that is high interest debt or debt that is on unreasonable terms or coming due within 12 months or to purchase an existing business. So here's a little bit about how the program's parameters for real estate purchases or refinances. The SBA is limited to $5 million. We can finance up to 25 years with a fixed rate, fully amortized loan. And on the purchase of business, we can do up to 93% financing. And that 3% is pretty much the SBA guarantee fee. On the term loans, again, you still have a $5 million cap. And if there's no real estate attached to the term loan, the maximum term is 10 years. It is fully amortized with no prepayment penalty. And you can use the use of proceeds, again, similar to the slide before, and you all get copies of the slides, what you can use that money for. So let's talk about business acquisition, because a majority of the requests that we are getting today are to purchase a business, right? A business acquisition. And this can be the employees buying the business for a retiring owner, or you have decided that you want to buy a franchise, you want to buy an ongoing concern. It is a lot easier to purchase an ongoing concern than it is to start a new business, right? Because everything is already in place. So again, maximum is $5 million, 10 years, fully amortized, 90% financing plus the fees. And there's two different ways of doing this. So if you have an arm's length transaction, you're buying a business from somebody you don't know, the most likely structure is going to be a 90% bank loan and you come up with 10% cash. But the SBA has made it a little bit easier for employees or friends and family to be able to purchase, in a friendly transaction. The business owners retiring, you work at the business, or you're just familiar with the business, we can do a 90% loan. We can do 5% cash down from the buyer, and then the seller can carry back 5% of that loan on full standby without any payments of principal and interest during the life of the bank loan. And the reason why a seller would want to do that is to help an employee to buy the business. The reason why the buyer would want it is because he has to come up with less down, and there's a little tax break for the seller because they don't get all their money in one fell swoop when the bank loan funds. The second loan we're going to talk about is the 504 program, and this is really for the purchase of is fixed assets, but primarily it's the purchase and refinance of commercial real estate. And when I talk about commercial real estate, I am talking about owner-user commercial real estate. And what does owner-user mean? It means that the business operations are occupying 51% or more of the usable square footage of that building. Right, so your business must occupy that building. You can lease out up to 49%, but we're not going to take that into consideration when we try to underwrite the loan. So the 504 can be used to purchase land, existing buildings. You can the improvements to those buildings, the construction of a new facility. It can also be used for long-term machinery and equipment. Usually, that's that really heavy-duty, expensive equipment, maybe 150,000 or more. We don't see a lot of equipment requests, but they can be used for this. You cannot use a 504 for working capital, business acquisition, or speculation or investment in rental real estate. So how is a 504 loan structured? It's very different than the 7A program, because what you're seeing here is you're actually getting two loans. So in a typical transaction, I'm using $10 million as the purchase price. The bank, City National, would do a $5 million first. The SBA would do a second for 40%, and then the owner would come out with 10% down. So that's really the typical structure, 50, 40, 10, right? But this is a great way to buy a building, especially as rents continue to rise in California. Sometimes it is less expensive to own the building. That payment will be less than what you're paying in rent. Who is qualified for a 504? You must be a private-owned, for-profit business. Can't be a nonprofit. Again, you must occupy 51% of the building. And then the qualifications, this is really about being a small business. So your net worth, less than 15 million, net profit after tax, no more than 5 million. And then there's other size standards depending on industry and number of employees that you can find at SBA.gov. On the second mortgage, so this is the part where the SBA finances, their loan can be no larger than 5 million, 5.5 for manufacturing, and 5.5 for green, when you green the building, when you purchase it and maybe add solar panels or that kind of thing and reduce the energy expense. So how much do you have to come up with when you want to buy that building? So it's 10% down for most transactions, office buildings, retail, manufacturing, warehouse. 10% is pretty much usually the standard of the down payment. If you're a startup business, we're going to ask you to come up with a little bit more. And if it's a special use property, we'll probably ask you to use to come up with a little bit more. The SBA will require a bigger down payment. And I'll give you an example. A ranch or a winery is a special use property, right? So a Taco Bell may be considered a special use property because you're not going to be, the bank can't take that building back and lease it out as an office space, right? The Taco Bell is a Taco Bell. So you'll come up with a little bit more down on those special use properties. Again, how the funds can be used, you can purchase, you can refinance. Those are, primarily the main uses for the 504. And again, those qualifications. So what do you have to bring to the table, right, when it comes to getting an SBA loan? We want to see profitability, right? We want to see profitability at least in the last completed tax return and the interim financial statement. You know, you may be diversifying your operations. You know, Rosalinda mentioned about the woman making masks. You know, we saw during the COVID crisis, many businesses, you know, shift what they were doing. There was a beer, you know, beer manufacturer, and they turned and were making that, you know, the sanitizing stuff, right? So, I mean, no, I would never have thought that they could pivot something like that. So there's a lot of things that you can use, and sometimes the SBA can help you with that. Your personal credit can have a couple of dings, but you're going to have to explain it to us. And, you know, in the SBA world, you know, banks always look for collateral, right? So, you know, what can we take if you don't pay back the loan, right? And usually it's real estate. So with the SBA, we don't need as much collateral. And if you have no collateral, that's not a sole reason for us to decline the loan. So I have done business acquisitions loans for service companies, you know, $3 million with absolutely no collateral, right? Because we have that comfortability with the guarantee the SBA gives us. And then we can actually utilize projections or projected revenue versus only historical. SBA allows us to do that. On the conventional side, we only use historical. So this is the fun stuff. What can't you use an SBA loan for, right? So we can't take your conventional loan and refinance it with an SBA if we know it's about to go bad, right? To get that guarantee so we don't lose money. To effect a change that will not benefit the business. Reimbursement of funds owed to any owner, including their equity injection. Repay delinquent state or federal taxes. So it's a government guaranteed loan. You can't use it to pay back your back taxes with. And for a non-sound business purpose. What does that mean? I use the example, hey, if I own a liquor store and I want to buy a racehorse, that is not a sound business purpose for a liquor store. It is for maybe, you know, a racetrack, but not a liquor store. So a non-sound business purpose. There are specific types of businesses that are not eligible for SBA loans. Real estate investment firms, multifamily, you know, buildings we can't do. Dealers, anything that is speculative, rare coins and stamps. Any firm that's involved in lending activities, so banks, finance companies, factors, leasing, we can't do any of that. And ineligible businesses include those where the owner is on parole. Other types of businesses that we cannot finance: pyramid sales plans, multi-level marketing, any business that's involved in illegal activities, gambling, and then charitable, religious, and nonprofits. You know, we see a lot of requests that come and actually touch marijuana, even though marijuana is illegal in California. The SBA is a government guaranteed program, and until marijuana is declassified, you cannot do anything with marijuana and get an SBA loan. Before I go on to the Q&A, I do want to mention also, if you buy a building and you want to lease some of that space, that tenant cannot touch marijuana either, right? So, and I've seen where, you know, they've gone out to look at the building, there's a dispensary in there, and they called the loan, right? Because it's technically in default. So make sure those illegal activities, you know, are not touching your building in any way. And that's it.
Thank you, Mark. Yeah, we have a couple questions here. I know Rosalinda gave her input as well, so I think that's super helpful, but I want to give you an opportunity to answer the questions as well. So this person says, we've been in business for 2 years and we're interested in applying for an SBA loan. My credit is decent, but I have school loans. Will the school loans affect our ability to access a loan?
So not necessarily, right? So in the case of student loans, and Rosalinda mentioned this in the global cash flow. So, in the SBA world, I'm looking primarily at the business income, but I also look at the personal income. And so, how I look at that is, does the personal income add or subtract, right? So if you're making enough money and you have disposable income, right, then it would add to my business income, right? But if you have business, if you have, personal debts and they exceed what your income is, we know that money has to come from somewhere. And so we're going to pull it out of the business income. So it'll actually reduce my ability to service that debt. So what we need to know is, how much does the business earn? Is it able to service that debt? And does your personal add or subtract, right? Because, student loans, I think, are still on a hiatus from payments. But once those payments go back into place, we need to know what those payments are, because we need to know how to add that back or, into the cash flow.
That's super helpful. Thank you. And then another question. So if someone does want to inquire if they're eligible for an SBA loan, and let's say they don't, they have a checking account and a business checking account, who do they get connected with at City National, for example, to learn more? Is there a person at each branch? Is there a specific place they go? How does someone get connected with someone to learn more about whether they're eligible or not?
So at City National, we're a little bit different in that we are a very high touch, relationship bank. And so all of our clients have a relationship manager, and they would start with that relationship manager to ask the questions. Hey, this is what I want to do. This is how much money I think I need. And the relationship manager will help direct them to which program would be best. Sometimes people come to me and say, hey, I need an SBA loan. And I'm like, well, what's the money for? Well, I need, a line of credit to carry my receivables. Are you profitable? Yes. Have you been in business for more than 2 years? Yes. Is the request 20% or less of your gross sales? Yes. Well, that would be a conventional loan. You don't need the SBA. The SBA is more expensive, right? And takes longer to fund. So the idea is that we want our relationship manager to have that conversation with the client to see which loan product is best fit for them. And if it is younger business, no collateral, it might come to the SBA. But we have those conversations with our clients to make sure.
Yeah, and can you talk a little bit about, maybe someone doesn't qualify for an SBA loan yet, maybe they are going to go the Accessity or a route or another micro lender. Can you talk a little bit about the importance of still cultivating that relationship with your banker, and why that's important when you are large enough or you are ready for an SBA loan?
So, luckily there's a lot of, opportunities out there, and a lot of training and a lot of sources, to help businesses grow and to get the information they need. But, remember, Accessity is not a bank, right? So that's a great place to start, to get that information, to get yourself ready to come to a bank. But you still need a checking account, right? You still need checking accounts, credit cards, you need, payroll accounts. All of those things are provided by the banks, right? They may not be able to start you with the financing because you're younger. That's where Accessity comes in. And if you need, training on how to, write a business plan, the Small Business Development Centers and SBA.gov can help you with, all kinds of courses that are free, right? That you go to because they've already been paid for by your tax dollars. Right? So you can go and have them help you with a business plan, help you with your projections, help you with the documents that you need. Remember that the bank is like going on a first date. So when you come to us, you have to be ready, right? You would never go on a first date with a twig in your hair and one shoe and a sock missing, and rumpled and not taking a shower, right? And many times that's exactly what we get when somebody comes to ask us for credit. Their financials are in disarray. I had one person bring me a box of financials that weren't even in order, right? And it said, can you help me? And I'm like, no, I can't help you, but let me send you to a place that can get you ready so that you come to that first date with the bank fully ready, and able to ask for that loan and get a better chance of being able to get it. when we see a loan package, that doesn't cash flow, or balance sheets that don't balance, when we see that stuff, it's hard for us to get over it, right? And look past it to be able to loan you money. So, take advantage of all these things that are out there to get you ready to come to bank financing.
Yeah, and I'll share some SBA, and I'll share the general link for the SBA with some of their free trainings, and then SBDC, and then SCORE is another great one, and they have offices all over Southern California. So I'll share those in the email that goes out after this webinar as well. Another question about SBA loans. Joseph says, I have a property that pays my mortgage. Property is located in a very good neighborhood, but it's an old house. I want to increase my rental income. I need to remodel, which will possibly double the income upon remodeling. What is the best loan to get for this project? And then he said SBA loan. Is that an option?
SBA loan is not an option because it's a residential property. So we don't finance residential properties, and it is a rental property. So that's one of those ineligible uses for SBA. You would have to go through the conventional mortgage type product.
Okay. And then Rosalinda, this is a question about purchasing a franchise as a startup. If I'm looking to purchase a franchise as a startup, will my personal income be the determining factor of loan approval or projections for the startup?
Yes, your personal income will be counted. Now, we can finance a franchise. We're going to need a franchise agreement. And it all depends what the cost of the franchise is, right? Because a lot of franchises are over 100,000. So if they are, for example, 150,000, you have to make sure you have 50,000 if you are going to request $1,000 from us, $100,000 from us. So if the franchise happen to be under 100,000, which is our max, we can definitely try to help you.
Yeah, that's great. And then we're nearing the end of the webinar, so please, any last minute questions for Rosalinda or Mark, please type them in, and we'll do our best to answer them.
Suzanne, I'll add
yeah,
to that franchise question. So, and a startup franchise, yes, that's a little bit more difficult. But let's say you're going to buy an existing franchise, let's say an El Pollo Loco that's in your neighborhood. We're going to look for three things, because you can get bank financing, SBA financing with that. We're going to look, hey, do you have the 10% down? Do you have management experience in the franchise that you're buying, right? Do you know how to operate an El Pollo Loco, right? And does that business already generate enough money to service this new debt, right? So if those three answers are yes, and it's existing, then we probably can finance it through the SBA program.
Yeah, that's a great point. Thank you so much for adding that. Any last questions? If not, we'll share a bunch of resources in the email after this webinar. I also recorded the webinar, so I'm going to go ahead and stop the recording. And I just want to go ahead